Hello students, welcome to the lecture on analysis of financial statements. And after this lecture, we will be able to learn the following objectives. Define the parameters of organizational health. Explain the concept and objectives of financial statement analysis. Discuss the comparative financial statements. Define common size income statements and balance sheets. Explain the trend analysis. Discuss the ratio analysis. Let's start with the concept analysis of financial statements. Financial statement analysis is a process that is used to determine the economic stability of a company. This task is normally performed by an accountant who would look at items like gross sales, company assets, and liabilities to determine how much a business is actually worth. Once each financial aspect of the company is reviewed, a detailed report can then be generated to provide information to any interested party. A financial statement analysis is completed for several different reasons as well, and it can be used to obtain an overall summary of a business or a very specific aspect of it.
Now that Mike has started his publicly traded pizza company, he needs to make sure that he has his financial statements and annual reports in order. An annual report has four basic financial statements: the balance sheet, the income statement, the statement of shareholders' equity, and the statement of cash flows. A balance sheet is a snapshot of the company's financial position on that day. The left side of the sheet contains assets, or things that the company owns. Assets are listed from the most liquid to least liquid. Examples are cash, accounts receivables, and equipment. The right side lists the liabilities and includes accounts payable and long-term bonds. Underneath liabilities is a stockholder's equity, which include preferred and common stock and retained earnings. Both sides of the balance sheet must equal, meaning assets equals liabilities plus equity. Next, the income statement will show how profitable the company is. The statement reflects performance over a certain amount of time. To get net income, Mike needs to take his revenues and subtract out any expenses, taxes, or preferred dividends. The statement of shareholders' equity deals with the changes of the equity portion of the balance sheet. This can include paying dividends, issuing or buying back stock, or retained earnings. The last statement is a statement of cash flows. This is a summation of cash flows within the company. Cash flows can be divided into three types of activities: operating, which measures cash used on core business opportunities. Downward trends or negative cash flow from operations almost always indicate problems. Investing activities, which includes investments or sales of assets. You can tell if a company has made any big acquisitions from this. And financing, raising cash by issuing debt or stock. This will tell you if the company is raising capital from its investors or returning it to them.
The basic purpose of a financial statement analysis is to determine what accountants refer to as cash flow. This is the amount of money that a business takes in over a certain period minus its overall debits and other expenses. Although this task may appear to be somewhat basic, there could be hundreds of factors involved that would change how much the business is viewed financially. Let us now discuss the parameters of organizational health. Organizational health is defined as an organization's ability to function effectively, to cope adequately, to change appropriately, and to grow from within. Organizational health consists of the following 8 dimensions. Goal focus, the ability of persons, groups, or organizations to have clarity, acceptance, support, and advocacy of school-wide goals and objectives. Communication adequacy. It states when information is relatively distortion-free and travels both vertically and horizontally across the boundaries of an organization. Optimal power equalization, the ability to maintain a relatively equitable distribution of influence between the leader and members of his/her work unit. Cohesiveness, the state when persons or groups have a clear sense of identity, are attracted to membership, want to stay and are willing to influence and to be influenced. Moral, that state in which a person, group or organization have feelings of security, satisfaction, well-being and pleasure. Innovativeness, that ability to be and allow others to be inventive, diverse, creative and risk-taking. Autonomy, that state in which a person, group or organization have the freedom to fulfill their roles and responsibilities. Adaptation, that ability to tolerate stress and maintain stability while changing to meet the unique needs of their stakeholders. Problem-solving adequacy, an organization's ability to perceive problems and to solve them with minimal energy. Problems get solved, stay solved, and problem-solving procedures are strengthened. Now moving on to the next topic, we will study the concept and objectives of analysis of financial statements. As we know, business is mainly concerned with the financial activities. In order to ascertain the financial status of the business, every enterprise prepares certain statements known as financial statements. Financial statements are mainly prepared for decision-making purposes, but the information as is provided in the financial statements is not adequately helpful in drawing a meaningful conclusion. The term financial analysis is also known as analysis and interpretation of financial statements. It refers to the establishing meaningful relationship between various items of the two financial statements, that is, income statement and position statement. It determines financial strength and weaknesses of the firm. Indicating the trend of achievements, financial statements can be compared and the trend regarding various expenses, purchases, sales, gross profits and net profit, etc. can be ascertained. Value of assets and liabilities can be compared and the future prospects of the business can be envisaged. Accessing the growth potential of the business. The trend and other analysis of the business provide sufficient information indicating the growth potential of the business. Comparative position in relation to other firms. The purpose of financial statements analysis is to help the management to make a comparative study of the profitability of various firms engaged in similar businesses. Such comparison also helps the management to study the position of their firm in respect of sales, expenses, profitability and utilizing capital, etc. Types of financial statements. Financial statements can be referred to as representation of the financial status of a company in a systematically documented form. There are different types of financial statements. Financial statements are required to be audited by authentic, efficient audit firms to avoid manipulation of numbers. Statements are usually audited by the accounting firms after a thorough study of the company records. These are balance sheet, income statement, balance sheet. The balance sheet provides an insight into the financial status of a company at a particular time. The balance sheet type of financial statement is different in comparison to the other types of financial statements. Other financial statements are prepared by taking into account the financial health of the company over a considerable span of time. Income statements, also known as P&L statement or the profit and loss statement. This statement ascertains the profit and loss of any business. This can be again of two types. Single-step income statement, multi-step income statement. Tools of financial analysis. Financial statements give complete information about assets, liabilities, equity, reserves, expenses and profit and loss of an enterprise. Cross-sectional analysis. It is also known as inter-firm comparison. This analysis helps in analyzing financial characteristics of an enterprise with financial characteristics of another similar enterprise in that accounting period. Time series analysis. It is also called as intra-firm comparison. According to this method, the relationship between different items of financial statement is established, comparisons are made and results obtained. Let's know the meaning of comparative size income statements and balance sheets. In brief, comparative study of financial statements is the comparison of the financial statements of the business with the financial statements. It enables identification of weak points and applying corrective measures. Practically, two financial statements, balance sheet and income statement, are prepared in comparative form for an analysis purpose. Comparative balance sheet. The comparative balance sheet shows the different assets and liabilities of the firm on different dates to make comparison of balances from one date to another. The comparative balance sheet has two columns for the data of original balance sheets. A third column is used to show change, increase, decrease in figures. The fourth column may be added for giving percentages of increase or decrease. Comparative income statement. The income statement provides the results of the operations of a business. This statement traditionally is known as trading and profit and loss account. Important components of income statement are net sales, cost of goods sold, selling expenses, office expenses, etc. The figures of the above components are matched with their corresponding figures of individually and changes are noted. The comparative income statement gives an idea of the progress of a business over a period of time. Common size income statements and balance sheets. Common size income statements and balance sheets. The common size statements, balance sheet and income statement are shown in analytical percentages. The figures of these statements are shown as percentages of total assets, total liabilities and total sales respectively. Take the example of balance sheet. The total assets are taken as 100 and different assets are expressed as a percentage of the total. Similarly, various liabilities are taken as a part of total liabilities. Common size balance sheet. A statement where balance sheet items are expressed in the ratio of each asset to total assets and the ratio of each liability is expressed in the ratio of total liabilities is called common size balance sheet. Thus, the common size statement may be prepared in the following way. The total assets or liabilities are taken as 100. The individual assets are expressed as a percentage of total assets, that is 100, and different liabilities are calculated in relation to total liabilities. Common size income statement. The items in income statement can be shown as percentages of sales to show the relations of each item to sales. Trend analysis calculates the percentage change for one account over a period of time of 2 years or more. To calculate the percentage between two periods, calculate the amount of increase, decrease for the period by subtracting the earlier year from the later year. If the difference is negative, the change is a decrease, and if the difference is positive, it is an increase. Divide the change by the earlier year's balance. The result, the percentage change. Trend percentages. To calculate the change over a longer period of time, for example, to develop sales trend, follow the steps as: select the base year. For each line item, divide the amount in each non-base year by the amount in the base year and multiply by 100. In the following example, 20W7 is the base year, so its percentages, see bottom half of the following table, are all 100.0. The percentages in the other years were calculated by dividing each amount in a particular year by the corresponding amount in the base year and multiply by 100. Calculation. The base year trend percentage is always 100.0%. A trend percentage of less than 100.0% means the balance has decreased below the base year level in that particular year. A trend percentage greater than 100.0% means the balance in that year has increased over the base year. A negative trend percentage represents a negative number.
The process of trend analysis compares figures over several time periods. Once again, dollar amounts are converted to percentages to obtain a relative basis for purposes of comparison. But now the comparison is across time. This chart is an example of a trend analysis chart. Let's take a closer look. Refer to the chart below. What trend do you notice from 2000 until 2004? What about 2004 to 2008? The trend from 2000 to 2004 shows that there was a steady increase of applicants from year to year. The trend from 2004 to 2008 shows a decline in applications. How did you do? I'm sure you are asking yourself, big deal, how does this help me? Read on. Let's take a closer look at the chart. If in Region B there were 1,200 septic tank applications in 2007, but there were only 900 applications in 2008, the difference between the 2 years is 300 applications, or negative 25%. Trend analysis is something called horizontal analysis because the computation of the percentage of difference is horizontal. Knowing that there were 25% fewer applications in 2009 than in 2008 is important for planning, control, and decision-making purposes, since fewer staff were required to process these applications and there was less travel associated with this program. If a similar change is anticipated for fiscal year 2009, the manager might plan to use 25% fewer staff and 25% less travel. What is the percentage difference between 2001 and 2002? 2004 and 2005? What trend do you observe that might lead you to believe that the number of applications in 2009 might be different than in 2008? Do you expect that this number might be higher or lower? So, here are our answers. We took the difference of the 2 years, then divided by the larger number. We then multiplied the answer by 100 to get a percentage. How did you do? The number of applications in 2009 should be lower than in 2008, based on the trend of the last few years.
The ratio is an arithmetical relationship between two numerals. It is expressed as a proportion or a fraction, or in terms percentage in terms of number of times. For example, expenses are 70% of sales, or sales of current year are 4 times more than that of the last year. Net profits are 1/10 of the capital employed, etc. Thus, accounting ratios are ratios formed out of figures taken from financial statements. These are calculated by placing two figures taken from financial statements in the form of ratio. They are tools in the hands of users and help the management in taking decision. Significance of ratio analysis. Analyzing financial statements from various aspects of a business through the techniques of accounting ratios is called ratio analysis. Ratio analysis is an important technique of financial analysis. It is a means for judging the financial health of a business enterprise. It determines and interprets the liquidity, solvency, profitability, etc. of a business enterprise. Simplification of accounting data. It becomes simple to understand various figures in the financial statements through use of different ratios. For example, a profit of $20,000 may not sound very impressive, but it is earned with the help of a capital of $20,000. It becomes easy to say that the profit is reasonably good by stating that it is 100% of the capital. Accounting ratios simplify, summarize, and systemize the accounting figures presented in financial statements. Helpful in comparative study with the help of ratio analysis, comparison of profitability and financial soundness can be made between one firm and another in the same industry. Similarly, comparison of current year figures can also be made with those or with the help of ratio analysis, and if some weak points are located, remedial measures are taken to correct them. Focus on trends. If accounting ratios are calculated for a number of years, they will reveal the trend of costs, sales, profits, and other important facts. Such trends are useful for planning. Selling standards. Accounting ratios based on a desired level of activities can be set as standards for judging actual performance of a business. For example, if owners of a business aim at earning profit, 25% of the capital which are prevailing the rate of return in the industry, then this rate of 25% becomes the standard. The rate of profit of each year is compared with this standard, and the actual performance of the business can be judged easily. Advantages and uses of ratio analysis. There are various groups of people who are interested in analysis of financial position of a company. They use the ratio analysis to work out a particular financial characteristic of the company in which they are interested. Ratio analysis helps the various groups in the following manner. To work out the profitability. Accounting ratio helps to measure the profitability of the business by calculating the various profitability ratios. It helps the management to know about the earning capacity of the business concern. In this way, profitability ratios show the actual performance of the business. To work out the solvency. With the help of solvency ratios, solvency of the company can be measured. These ratios show the relationship between the liabilities and assets. In case external liabilities are more than that of the assets of the company, it shows the unsound position of the business. In this case, the business has to make it possible to repay its loans. Helpful in analysis of financial statement. Ratio analysis help the outsiders, just like creditors, shareholders, debenture holders, bankers, to know about the profitability and ability of the company to pay them interest and dividend, etc. Helpful in comparative analysis of the performance. With the help of ratios analysis of a company may have comparative study of its performance. In this way, company comes to know about its weak point and be able to improve them. To simplify the accounting information. Accounting ratios are very useful as they briefly summarizes the result of detailed and complicated computations. Limitations of ratio analysis. In spite of many advantages, there are certain limitations the ratio analysis techniques, and they should be kept in mind while using them in interpreting financial statements. The main limitations of accounting ratios are limited comparability. Different firms apply different accounting policies. Therefore, the ratio of one firm cannot always be compared with the ratio of other firm. Some firms may value the closing stock on LIFO basis, while some other firms may value on FIFO basis. Similarly, there may be difference in providing depreciation of fixed assets or certain of provision for doubtful debts, etc. False results. Accounting ratios are based on data drawn from accounting records. In case that data is correct, then only the ratios will be correct. For example, valuation of stock is based on very high price. The profits of the concern will be inflated and it will indicate a wrong financial position. The data therefore must be absolutely correct. Effect of price level changes. Price level changes often make the comparison of figures difficult over a period of time. Changes in price affect the cost of production, sales, and also the value of assets. Therefore, it is necessary to make proper judgment for price level changes before any comparison. Qualitative factors are ignored. Ratio analysis is a technique of quantitative analysis and thus ignores qualitative factors which may be important in decision making. Now, in the end, let us summarize what we have learnt in this lecture. Organizational health is defined as an organization's ability to function effectively, to cope adequately, to change appropriately, and to grow from within. Financial analysis helps in ascertaining whether adequate profits are being earned on the capital invested in the business or not. The balance sheet type of financial statement is different in comparison to the other types of financial statements. Accounting ratios based on a desired level of activities can be set as standards for judging actual performance of a business. Ratio analysis helps to work out the operating efficiency of the company with the help of various turnover ratios. Financial statements give complete information about assets, liabilities, equity, reserves, expenses, and profit and loss of an enterprise.